Hi, hello friends, welcome everyone to Precision Price Action Pro Trader series. In this special video today, we are going to discuss about the art of marking special zones. What do you mean by a special zone? A zone which creates some sort of turbulence, some sort of disturbance to the trader community is called as a special zone. Let's deep dive and understand how it works. Alright friends, what do you see here? You see a beautiful rally, base and drop, right? Now, when you look at this particular scenario, there is a slight variation. When you mark a zone, we always spoke about marking the base. For example, taking the top of the base and then marking the bottom of the base if you want wick to wick, marking the bottom of the body and then top of the base if you want body to wick, correct? That is how you try to mark the zones. However, if you try to mark a zone like this now, if this becomes your distal line and this becomes your proximal line, for example, and if price by any chance come here, you expect the price to react from this point. However, many times price will not react from this zone, it goes, many times price goes there, it can do a slight fake out and fall down. Why? Why would price do a fake out like this? It is because price has already gone to this level before. If you are a player, if you are a marathon runner, if you are trying, say for example, a competition of 42 kilometers is the longest marathon, right? If you are a man who has already traveled 50, where is the challenge for you? You will happily go there and you come back. For a person who has already reached 50, the challenge should be 60, not 40. Similarly, whenever you see this kind of a scenario, all you should do is to take the topmost point, not this one. No. You should take the topmost point as the distal line for any chance of price breaking out from this region. This is a risky zone, but this is a safe zone to put stop loss. So, technically what happens? This becomes your distal line, this becomes your proximal line if you want, or you can even take this as your proximal line, you can take this as your proximal, you can take wherever you want as your proximal line. However, the distal line should always be at the topmost point. That is a message and key takeaway from this particular scenario. Now let us move further. This becomes your proximal line. If you take this, there is every possibility of price going up, breaking that level and going down, and hence your distal line should always be the topmost point. Sounds good? Chalo, let us quickly jump into the next scenario. Look at this. In the previous scenario, you saw that the base was here, correct? Your base is here, rally, base, drop, correct? Now, if you look at the overall candlestick formation, in the previous scenario, you saw the third candle having the highest possible high. Here, which is the highest high? This one. This becomes your distal line, maybe this becomes your proximal line. Is it fair? And when price comes back to this point, you expect it to react. Because this is the farthest point that the price has already traveled. And hence, if price has already traveled to that level before, there is every possibility for the price to go back to that point, and hence your stop loss should always be above that. Make sense? So that's what happens here. That's your proximal line at the bottom. That's your standard distal line, which is not correct because price can always break it, and hence your distal line should always be at the topmost point, which is this. Okay? Super. Now let me draw yet another scenario. Okay? In this scenario, friends, you have two bases, correct? You have base 1 and base 2. Everyone agree? Now try to blend that base. See if you can blend that base. You can blend it. Take the open of the first candle, right? Open. Let us say this is the open. Close of the last candle, this is the close. Highest high, lowest low. Everyone agree? So my candlestick is this. Correct? Roughly that is my candlestick. Similarly, if you try to mark the zone, you cannot take this as the proximal distal line. No. Neither this nor this. It should always be the farthest point the price ever reached, because there is every possibility for the price to go back to that point and react from there. Make sense? Is it sensible, friends? That's your proximal line. That's your distal line. So when price goes there, you expect a strong reaction. So when you merge, this becomes a bigger candle. Sounds good? We should make sure that the stop loss is always the topmost point. Now I will throw you one more interesting challenge. How do you mark this? A strong rally followed by a strong drop. What is this? Bearish engulfing. The bear engulfed a bull. How do you mark this? As usual, you will take maybe the top of that body and the topmost point of the first candle, because that is the highest high, because that is a level where price have already gone. So technically that becomes your distal line, this becomes your proximal line. What is proximal line? Proximal line is a line which is very close to the price, and distal line is a line which is very far away from the price. So when price comes there, you expect a good reaction. So in a nutshell, this is one of the most simplest and unique way of forming stop loss levels. The science and art of trading is not about making profits. The science and art of trading is all about protecting your losses, protecting your capital, controlling your losses, reducing your losses. Stop loss is not stopping a loss. Stop loss is stopping a big loss. You can never stop a small loss, because that is part and parcel of any trader's life. With this, we come to the end of this session on special zone marking successfully. In the next video, I will come back with some more interesting updates. Until then, thank you very much.
Are you tired of stock market losses? Tired of hundreds of boring indicators and the frequent drawdowns? Do you want to understand how to trade markets without indicators? How institutions cheating the retail traders, and how to make fair and consistent trading methods? The answer is IT3T Mega Webinar, India's most comprehensive and 100% money back guarantee training program for stock market investing and trading. And what do you learn from this webinar? Techno fundamental investing, WD GAN techniques, precision price action trading, the option trading strategies, algo trading, and also trading psychologies. So it is a package of 200 world-class investing and trading books jam-packed into the 12 days of webinar. And what you can expect from IT3T: genuine training program with examples and assignments, no indicators, real-life examples, proven and reliable methods. And what you shouldn't be expecting is holy grail formulas, zero loss strategies, 90% win rate stories, get quick rich Ponzi schemes. And we also have students across the globe. The three thing IT3T always promises is 100% money back guarantee program, 100% brokerage credit, 100% lifetime learning. But that's not it. We have an early bird offer for you at just 35,000 rupees for first 25 students. So how do you enroll the IT3T program? Simple. Just log on to www.i3t3.in or contact our webinar manager